Welcome to the Global View, where we look for ways for investors to make money beyond the ASX listed universe. Getting to a view, and ECB President Christine Lagarde added fuel to the higher for longer fire, saying rates maintained at current levels for long enough would return inflation to target in a timely manner. But there's been buzz growing around private credit. Let's take a listen to Brian Payne from BCA Research.
First, I'd like to say that while there is a lot of interest in private credit versus maybe private equity that you hear, you're not necessarily seeing the same type of dollars follow private credit over private equity. A lot of this has to do with the over allocations within private equity, particularly at the large institutions overall. But then to hit kind of at your second point there, yes, the interest rate environment is looking a lot more conducive to be a lender of capital going forward. From this point going forward is what we say the next new loan going into the ground has a much better yield on it and a much better risk profile on a going forward basis.
Okay, and so Brian, when we think about where the opportunities will come from going forward, how do you see that playing out in a higher for longer environment?
Well, first and foremost, as you said, it's a higher for longer that interest rates, particularly the ones that are focused on floating rate notes, which is the most common amongst private credit, where you're getting a yield of its LIBOR or SOFR plus, and if yields stay higher for longer, well, LIBOR or SOFR stays higher for longer, making the all-in yield higher for longer. And then you'd also take into account, well, what is the impact of higher interest rates, particularly the discount rates, reference rates, et cetera, on growth going forward. And we do see a number of issues kind of in the pipeline as it relates to credit and equity as a whole. But that is when spreads typically blow out. And that's when you really want to be allocating into credit-focused instruments, yield-focused instruments that have that LIBOR plus. Because as spreads blow out, you can put that leverage on it and you can enhance the return by that much more.
Okay, so strategically, there's moves that you can make. But when you look at the environment and the different types of private credit and the opportunities on offer, like where do you see the most upside for investors?
Yeah, so one of our favorite arenas right now, well, first of all, we are positive on private credit across the board. One of our favorite sub-asset classes at the moment would be distressed debt, and that's the anticipation of the distressed opportunities in the pipeline, as well as the macro indicators that we do see, and they're all flashing green, particularly an inverted yield curve. When you look across developed markets, we haven't seen it this inverted for this long. The last time this happened was in the 1980s, which a recession did follow, a more prolonged type of recession, but not the type of recession such as the GFC that most of us have is much fresher on our memory. So this type of environment or prolonged environment is going to give a lot of good opportunities for distressed debt, which we really haven't seen for a good 10 to 15 years, barring that March of 2020 drawdown. But that distress opportunity went away quite quickly. Going forward, we see a lot of what we call bites at the apple for distressed debt investors overall.
Okay, but what are the risks associated with distressed debt in particular?
Well, the fact that you could get an distressed instrument, whether that's a loan, maybe there's some structuring, particularly with what you do on the equity side of the balance sheet, and that the ability for that growth or that realization of appreciation could just be a little bit longer as opposed to, maybe it falls and maybe those loans fall to 40, 30 cents on the dollar, but maybe it takes a few more years for them to come back out, depending on what type of restructuring you go through overall. The other element of risk we'd say for distressed debt, it's not very much an income focused asset class because it's in distress. They're not paying those coupons. So you have to be aware of that when you're looking at it as a credit focused asset class, because most often you're thinking income generation. This typically has more characteristics of equity-like risk going forward, but there is the diversification benefit just given the structure of the distressed debt overall, the entry points, et cetera, relative to equity broadly.
Okay, so that's an interesting point. So this is the time now for that sort of distressed debt, or do you reckon, just given the big picture that we've been talking about, credit versus equity, do you think that the conditions will remain in place for, to favor credit over equity for some time, for a long time? What do you think?
Yeah, it's a very good question. So, what we typically say is more often than not, if you're a long term investor, which those are the folks who we're working with, you really need to own equity long term. But then there's those times, and this is one of those times where it makes a lot of sense to lend. So, over the coming years, we do see the opportunity of being a lender of capital, being very opportune. However, that typically is a 1 to maybe 3 year typical time horizon, given the interest rate environment, the challenges we have with inflation, that will most likely prevent central banks from re-steepening the yield curves, pushing interest rates down in the coming kind of quarters and years, that it could be more of a 2, 3, 4, 5 year type of opportunity set because of those types of challenges in this upcoming cycle.
All right, let's check in on where the local market is set to open when trade gets underway in just a couple minutes' time. SPY futures down by about 7 points, or less than 0.1%. And just a tweet from Jonathan Payne, because, bond yields are rising right around the world. He says, here comes the pain as so many charts are breaking bad. So he writes the Payne report. He actually joins us on the program once in a while. He said, bond charts look horrible. The U.S. curve is steepening rapidly. Real yields and the Italian 30-year yields, ouch. Colossal unrealized bond losses in the banking system. So there is a bit of a red flag coming from the Payne report. Well, that does it for this edition of The Global View. Stick around. The Open is coming up next.